The housing market is fractured. One side is doing quite well, the other, not so much. We're going to discuss what's causing this and what this means for the prospective home buyer and seller. This is a current trend. Stocks and bond yields are on the rise. In white, 10-year US Treasury. It's been strong over the past couple months, very much correlating with the S&P 500 as well. Both markets seem to not anticipate a recession anytime soon. This is a recent headline. April home sales slow with high mortgage rates. That's putting a chill into the spring buying season. Now, why are mortgage rates rising? Here's a 10-year US Treasury again, just hit 458 on the yield. That's the highest level we've seen since mid-February. These are very high yields indeed. Now, here's a headline. Buyers rush into the market for new homes in April. That's the best number in the past 3 years. This is in multiples of 1,000. New homes sold, 743,000. That is the best number, again, we've seen in quite a long time. We also have new homes for sale. Again, these are new homes, 504,000. That's the second best number we've seen in quite a long time as well. So the new home sales data looks good. But there is the great housing market divide. On the left, buyers rushed into the market for new homes in April. On the right, existing home sales slow amid weakening buyer demand. And that is a divergence, the difference between new homes and existing homes. This is existing home sales, 4 million reported last month. That is the worst number we've seen going back to October of last year. Certainly a lot different than what we saw with the new home sales. Here's the housing market inventory, and this really tells the whole story. See, this is the monthly supply for new homes for sale. This shows us if we sell the homes in inventory at the current pace of sales, how many months of inventory do we have to work off? In terms of new homes, we have 8.1 months, 8 months of inventory at the current pace. However, we contrast that to the existing homes, we only have 4.4 months, virtually half of the inventory. There's half as many existing homes in terms of the amount it takes to sell in a month as we do for new homes. And that is quite curious why there's such a divergence between the two. Why is there a split in the housing markets? Well, there's a number of reasons. In terms of existing homes, we have something called the lock-in effect. We've spoken about this several times. That's where an existing home buyer or home owner that perhaps would like to sell, they have a low interest rate mortgage. They don't want to sell their house and buy another house and, roll themselves into a new high interest rate mortgage. And that's why they're kind of staying put. They're locked into their existing home. New home buyers, that's not a risk because a home builder builds a new home. There's no prior mortgage to consider. Now, in terms of the new homes, there's a great deal more supply. We saw 8 months versus 4.4. The existing homes, there's a much tighter supply. Also, the new homes, and this is something they don't really report very often, the new homes they're building are smaller. Now, the average new home for sale is about 403,000 versus the older, larger homes, which averages around 414,000. However, the new homes are typically more expensive. But what they're doing is they're making the new homes smaller so they're able to underprice or undercut the existing homes on the market. Now, of course, when we look at the size of the house, we can detect a difference. But on the surface, these cheaper prices are certainly luring prospective buyers. Also, new home sellers, meaning the home builders, they have incentives that they can offer. Existing homeowners, not so much. Also, the new home builders, they have a lot more flexibility. They can move into different regions. An existing homeowner, well, they have their house and they're constrained by personal economic conditions. They might not be able to sell because of work conditions or some other factor. So, when will rates decline? As a 10-year bond yield and interest rates are keeping mortgage rates quite high, the logical question is when are they going to go down? Well, these are the odds of no change in interest rates in the June meeting. And we can see, compared to the blue line, that's the S&P 500, there's quite a strong correlation. We've spoken about this recently as well. The stock market likes the fact that the Fed does not need to cut rates. They don't see bad news, and that's a good thing. But as we see a continued climb in the anticipation the Federal Reserve will not cut rates. How severe is this? Well, in the June meeting, remember, not too long ago, we were talking about a 60, 70% chance the Fed would cut rates in June. Now there's only a 2% chance of a Fed cut. They're not cutting rates in June. There's also only a 24% chance that the Federal Reserve will cut rates by a quarter point in June, or I'm sorry, July. That's not happening. And we have to go all the way out to September. And even at September, we have a 48% chance of a quarter point cut and only an 11% chance of a half a point cut. So the Fed funds futures market have really taken off the table the prospects of an interest rate cut anytime soon. And that is quite revealing about what we may expect for the 10-year bond and also, unfortunately, mortgage rates. The takeaways from this: strong new home sales. That helps the home builders. Think of the corporate earnings, companies like Lennar and I. Those are home builders that are certainly doing quite well because there is demand because of the techniques they have employed. Existing homeowners, it's not such an easy situation. And there's also far less supply as well. And that's really constraining the markets. Also, interest rates remain elevated until the Fed is ready. The Fed is not ready. So the question is, when will the Federal Reserve eventually cut rates? When we see, according to their dual mandate, the prospect that the jobs market is worsening and that inflation is also coming down. But if you recall, the last PPI data, well, it was cooling, and so did the CPI, but there still is a divergence between the PPI and CPI, and that translates into higher costs to the retailer. We spoke about this very recently in our PPI report, but nevertheless, inflation's come down. It has not come down enough for the Federal Reserve to cut rates, and certainly with the recent strong jobs number, they don't have any urgency to do so either. Next week, we have a slew of economic data. Durable goods. Those are those goods produced to last at least 3 years, washing machines, computers, very closely linked to the housing market, and certainly very important to consider. We have the Case-Shiller Home Price Index, Federal Reserve meeting minutes will be released, gross domestic product, pending home sales, and a very important PCE inflation data that will be released all next week as well. We're certainly going to be on the lookout for big news and how that could impact interest rates, mortgage rates, and the prospect of our future economy. We hope this has been helpful. We look forward to seeing you back soon.